While Washington celebrates full Treasury auctions and strong economic data, the world's largest economies are doing something they've never done before, walking away from American debt. No announcements, no drama, just billions vanishing into gold vaults. And January 2026 might be the month we realize it's already too late to turn back. The new year didn't burst onto the scene with panic or chaos. There were no emergency press conferences, no market crashes that made headlines, no frantic calls between world capitals. Instead, January 2026 slipped in like fog. Quiet, gradual, and impossible to ignore once you noticed it was there. But if you knew where to look, the signs were unmistakable. Across global financial centers, something unusual was happening. Central banks were quietly trimming their exposure to United States government debt. Pension funds were revising their long-term strategies. Reserve managers were making adjustments that, on paper, seemed routine. But the timing, the coordination, that told a different story. These weren't emergency moves. They were calculated, methodical, and deliberate. The kind of decisions institutions make when they've already seen the writing on the wall and decided not to wait around to watch it get worse. And here's the thing. When the world's most powerful financial institutions stop trying to shape the future and start protecting themselves from it, that's not a warning sign. That's the signal that something fundamental has already changed. At the World Economic Forum in Davos this January, U.S. Treasury Secretary Scott Bessent stood before a room full of global elites and dismissed the idea that anything significant was happening. His message was clear: don't believe the noise. Treasury auctions are strong. Demand is solid. The system is stable. But outside those conference halls, in the dealing rooms of Frankfurt, Tokyo, Seoul, and Mumbai, a very different conversation was taking place. Capital doesn't wait for reassurance. It doesn't care about speeches or sound bites. It moves based on risk, return, and trust. And right now, all three of those pillars are shifting beneath the foundation of the global financial order. Bessent specifically mocked concerns that European institutions were reducing their holdings of U.S. Treasuries. He singled out Denmark, dismissing its position as insignificant, too small to even register on the radar. He pointed to robust participation in recent debt auctions as proof that foreign appetite for American bonds remained strong. But here's what he didn't say. It's not about the size of any single country's holdings. It's about the pattern. And the pattern is unmistakable. Denmark wasn't making a statement. It was making a decision. One that dozens of other institutions across Europe, Asia, and beyond are quietly making at the same time. This shift didn't start in 2026. It didn't even start during the Trump administration. To understand what's happening now, you have to go back nearly 2 decades. The International Monetary Fund keeps meticulous records of global reserve flows, and if you trace those records back to 2008, you find the first crack in the system. When the U.S. housing market collapsed and dragged the global economy down with it, the Federal Reserve did what central banks do in a crisis. It flooded the system with money. The Fed's balance sheet exploded as it bought up trillions of dollars in assets to stabilize financial markets. It was supposed to be temporary, an emergency measure, but it never stopped. Then came the pandemic. Trillions more poured into the economy. Stimulus packages, quantitative easing, emergency lending programs. The printing presses, metaphorically speaking, ran non-stop. Foreign reserve managers took note. The dollar was no longer just the world's reserve currency. It was becoming a tool of domestic policy, expanded and contracted at will, with consequences that rippled across every economy on Earth. And once that precedent was set, everything changed. Scott Bessent's dismissal of European concerns wasn't just tone-deaf, it was strategically dangerous. Because what European investors heard wasn't reassurance, it was confirmation. Confirmation that U.S. government debt is no longer a politically neutral asset. That holding treasuries now comes with strings attached. Strings that can tighten without warning, depending on who's in power and what geopolitical pressures are in play. Denmark's reduction in Treasury holdings wasn't an isolated incident. It was part of a continental trend. Bloomberg data shows that Europe's largest pension funds cut more than $10 billion in U.S. government bond holdings last year alone. And when asked why, their answers were unusually blunt. Weakening fiscal discipline in the United States, a declining dollar, heightened political uncertainty under President Donald Trump's return to office. These aren't fringe concerns. These are the risk assessments of institutions managing trillions in retirement savings, infrastructure funds, and sovereign wealth. For a pension fund with a 30-year mandate to protect purchasing power, the math is simple. Financing U.S. debt increasingly means financing tariffs, trade wars, and unpredictable policy swings that directly harm the economies those funds are meant to serve. Why would Germany's largest pension fund help finance policies that make German exports less competitive? Why would France underwrite sanctions that disrupt its energy security? The answer is, it wouldn't, and it isn't. If Europe's pullback was a concern, what's happening across the BRICS nations is a full-scale restructuring. Russia exited U.S. Treasuries entirely years ago. After Western nations froze Russian dollar-denominated assets in response to the Ukraine conflict, Moscow made a decision. If your reserves can be turned into leverage against you, they're not really reserves at all. China has been more gradual, but no less deliberate. Rather than dumping bonds in a way that might spook markets, Beijing has simply let them mature without reinvesting. U.S. Treasury data confirms this. Chinese holdings have been declining steadily, not through fire sales, but through calculated non-renewal. But the most strategically significant shift? That's coming from India. India's holdings of long-term U.S. Treasuries have fallen from nearly $230 billion to around $174 billion. That's a drop of roughly $56 billion, a staggering amount by any measure. Some of that was used to stabilize the rupee during periods of currency volatility. But according to sources familiar with Reserve Bank of India discussions, as reported by the Wall Street Journal, the primary driver isn't economic management. It's sanctions risk. India is in a uniquely vulnerable position. It relies heavily on Russian oil. Roughly 36% of its crude imports now come from Russia, nearly double China's exposure. That dependence exploded after Western sanctions on Moscow sent discounted Russian barrels flooding into Asian markets. For India, this was an economic lifeline. Cheaper energy meant lower inflation, more competitive exports, and breathing room for an economy still recovering from the pandemic. But it also created a geopolitical minefield. President Trump has repeatedly characterized the BRICS bloc, Brazil, Russia, India, China, and South Africa, as adversarial to American interests and a direct threat to dollar dominance. India is already facing elevated tariffs on steel and aluminum. Unlike China, it doesn't have the leverage of deeply integrated supply chains that American companies depend on. Now imagine this scenario. Washington expands secondary sanctions to target any country buying significant quantities of Russian energy. India would be hit immediately, and if, at that moment, $174 billion of India's foreign reserves were locked in U.S. Treasuries that could be frozen or sanctioned, the rupee would collapse. That's not speculation. That's exactly what happened to Russia, and Venezuela, and Iran. Reserve managers in New Delhi aren't waiting to find out if it could happen to them. They're acting as if it already will. Gold, the asset with no issuer. Here's the critical detail. India didn't just reduce its treasury holdings, it reallocated them. Even as exposure to U.S. debt fell, India's total foreign reserves grew last year, according to IMF data. The difference? Gold. India has been aggressively accumulating gold, and it's not alone. China and Russia are doing the same. So are central banks across the Middle East, Southeast Asia, and Latin America. This isn't about nostalgia for the gold standard or distrust of modern finance. It's about one simple, undeniable fact. Gold has no issuer, no jurisdiction. No legal authority that can freeze it, sanction it, or devalue it with a policy decision. The World Gold Council reported figures that should make every Treasury official in Washington pay attention. Global central bank gold holdings now exceed $5 trillion in value. U.S. Treasury holdings? Closer to $4 trillion. For the first time in modern history, the world's reserve managers are holding more gold than American debt. Let that sink in. Europe's gold awakening. Even Europe, long considered America's most reliable financial partner, is beginning to rethink its assumptions. In Germany, a debate that once seemed fringe is now entering mainstream policy discussions. Should the Bundesbank bring home gold reserves currently stored in New York's Federal Reserve vaults? Officially, the Bundesbank has downplayed any seizure risk, but the fact that the conversation is happening at all represents a tectonic shift. After watching Russian reserves frozen and Venezuelan gold rendered inaccessible, German lawmakers are asking a simple question: if push comes to shove, who controls Germany's wealth? Legal jurisdiction matters, and right now, a significant portion of Germany's gold sits on American soil, under American law, subject to American enforcement. That didn't feel risky in 2015. It feels very different in 2026. The currency crunch. As January unfolded, the strain that had been building beneath the surface began showing up in currency markets. The dollar has been weakening steadily, extending a slide that began in late 2025. U.S. stock markets posted modest gains during this period, which on the surface seemed like good news. But for foreign investors, those gains evaporated the moment they converted their returns back into their home currencies. When your asset appreciates in dollars but the dollar itself is falling against the euro, yen, or rupee, your real return is negative. You're losing purchasing power even as your portfolio shows green numbers. And U.S. Treasuries? They're offering no relief. The 10-year Treasury yield is hovering just above 4%. That sounds reasonable until you factor in hedging costs. For a European or Asian investor, currency hedging typically costs 2 to 3% per year. Suddenly, that 4% yield becomes 1 to 2%, barely enough to beat inflation, and certainly not enough to justify the political and sanctions risk that now comes attached. Add to that the rising chorus of political warnings directed at anyone deemed a bond seller, and you have an asset class that punishes exit. An asset that punishes exit is not a reserve asset. It's a trap. The auction mirage. Treasury Secretary Bessent's confidence in auction results isn't entirely misplaced. Auctions are clearing, bonds are being sold, demand appears solid. But the behavior underneath has changed. Primary dealers, the major banks required to participate in Treasury auctions, are reducing their exposure to long-dated bonds. Instead, they're concentrating on short-term bills. Maturities of weeks or months, not years or decades. That's not a vote of confidence. That's a hedge against being locked in. Short-term bills offer flexibility. If conditions deteriorate, you're not stuck holding a 10-year bond that's losing value. You can exit cleanly when it matures in 90 days. Officials can point to strong auction results all they want. Reserve managers are looking at what's being bought and what's being avoided. The reporting lag. Here's the problem with tracking this shift in real time. The data is always late. Treasury International Capital, or TIC data, the official measure of foreign holdings of U.S. debt, often lags reality by weeks or even months. By the time the numbers are published, the positioning has already changed. This is why large-scale reallocations feel sudden even when they've been building gradually. Russia's exit looked abrupt when it finally showed up in the data. But Russian officials had been planning it for years. China's reduction seems incremental in each monthly report. But zoom out, and the trend is undeniable. India's $56 billion drop? That didn't happen overnight. It unfolded bond by bond, maturity by maturity, over quarters and years. The aggregate picture is only now coming into focus, and it's revealing a fundamental realignment that most policymakers in Washington either haven't noticed or are choosing to ignore. South Korea's turn. South Korea is watching all of this very carefully. Seoul faces direct exposure to U.S. trade policy. Tariffs loom over its auto and pharmaceutical sectors, two of its largest export industries. Samsung and SK Hynix have temporary exemptions because American tech companies still depend on their advanced semiconductors. But that shield is temporary. Once U.S.-based semiconductor fabrication plants are fully operational, something both Intel and TSMC are working toward, Korea's leverage disappears. Taiwan learned this lesson through TSMC's experience. Korea is studying the playbook. In late January, reports emerged that the Trump administration was considering raising tariffs on Korean goods from 15% back to 25%, specifically targeting automobiles and pharmaceuticals. The accusation? That Seoul had failed to meet investment commitments made during earlier negotiations. The timing couldn't be worse. The Korean won had only recently stabilized after hitting multi-year lows. Equity markets were fragile, and automobiles represent roughly 27% of Korea's exports to the United States, with American buyers accounting for nearly half of total production. When the tariff threats resurfaced, Korean auto stocks dropped sharply in a single trading session. Korea's options are limited. Retaliating risks losing access to U.S. consumers. Currency intervention drains reserves. That leaves one tool: reserve diversification. The Bank of Korea has publicly discussed resuming gold purchases for the first time in over a decade. With just over 100 tons currently held, Korea is dramatically underweight in gold compared to the geopolitical and economic risks it faces. Across Europe, Asia, and the global South, the same conclusion is forming. U.S. Treasuries are still high-quality assets. They're still liquid. They're still backed by the world's largest economy. But they're no longer politically neutral. Holding them now comes with conditions. Conditions that can change. Conditions that can be weaponized. Conditions that make them unsuitable as the foundation of a truly independent reserve strategy. Gold generates no income. It pays no interest. But it also has no issuer, no jurisdiction, no sanctions trigger. In a world where financial assets can be frozen, seized, or rendered inaccessible by geopolitical decisions, that trade-off is starting to make sense. The transition is quiet, deliberate, almost invisible on a day-to-day basis. Bonds mature and aren't rolled over. Auctions still clear, but demand is thinner at the margins. Yields rise incrementally. The dollar weakens gradually, and each move reinforces the next. No single transaction destabilizes the system. The risk lies in accumulation. It's like watching a levee erode. The cracks don't appear all at once. Water seeps through, one molecule at a time, weakening the structure from within. And by the time the breach becomes visible, the damage is already irreversible. As January 2026 comes to a close, the question is no longer whether the dollar will collapse in some dramatic, catastrophic event. The question is whether the global financial system is quietly, methodically evolving towards something entirely different. A system where U.S. Treasuries are still important but no longer indispensable. Where gold and alternative reserves play a larger role. Where exit strategies are built into every major portfolio. A system where holding American debt requires permission to leave, and where that permission can be revoked at any time. That's not a reserve currency. That's a cage. And the world's most powerful institutions are realizing it. The signs were there all along. We just weren't paying attention. While headlines focused on stock market records and unemployment numbers, the foundation of American financial power was quietly shifting beneath our feet. Europe is hedging. Asia is diversifying. Gold is back. And the dollar? It's still king. But even kings can be overthrown, not by revolution, but by 1,000 quiet betrayals. If this opened your eyes to what's really happening behind the curtain, hit that subscribe button. We're tracking the stories the mainstream won't touch, the ones that will reshape your world whether you're ready or not. Next week, we're diving into what happens when the Treasury auction finally fails. You won't want to miss it. This is the beginning of the end of an era, and you're watching it unfold in real time.